Good afternoon, everyone. Thank you for joining us for today's Employee Retention Credit webinar. My name is Mark Heath, and I'm a partner here with McConnelly and Asbury, and I'm also Director of Tax Services. Just quick blurb about the firm. We're a team of CPAs and business advisors serving clients from all of our offices. We have offices in Bloomsburg, Camp Hill, and Lancaster. We provide advisory and business consulting, audit and assurance, entrepreneurial services group, which is kind of your back office accounting support, internal audit, professional placement services, tax, and IT services across a broad range of industries, including affordable housing, construction, employee benefit plans, family-owned businesses, manufacturing, distribution, nonprofits, and healthcare. During today's webinar, if you have questions, please submit them through the built-in questions function in the webinar control panel. And please, please, please do not hold back on your questions. There's a lot of nuances to this topic. We're happy to walk through them, through all of your questions. And if I don't have an answer for you today, I will get you an answer. And I have 17 different resources all pulled up, ready to search through if I need to. But if I can't answer the question today, I will get you a question later on. If you're in the market for CPE, you must answer all 3 polling questions during today's webinar. And I am not shy about making sure that you know that there's a polling question. I get it. I need CPE too. So if you hear me yell CPE really loud, you'll know it's your turn to answer a question. CPE certificates will then be sent to you within 2 weeks after the presentation. All right. The background of the employee retention credit. So the employee retention credit, up until really the first few months of 2021, we weren't focused on this much at all. And virtually none of our clients were focused on it because originally the employee retention credit was only available to companies that did not take a PPP loan. The vast majority of our clients, I venture guess to say almost all of our clients, if not all of our clients, took PPP loans. So they were not in the market for ERC. They weren't looking for it, weren't paying attention, didn't know the rules, didn't care because there was no benefit for it. And we were kind of in the same boat. I think I had one client who was too big for a PPP loan. And because of the way the employee threshold works, if you had more than 500 employees, you couldn't take a PPP loan. If you were under 500, you probably took a PPP loan, so you didn't care about employee retention credit. Then by definition, if you couldn't get a PPP loan, that meant that you were eligible for ERC, but because of the employee thresholds that we'll talk about later on, you were limited to only wages paid to employees who were not working. And not many companies did that. So like I said, we'll get into that later on, but this is why we're here talking about this today. I mean, we're 2 years after this was first rolled out, and we're still talking about it. We're still running into companies on a regular basis that this wasn't on their radar. They forgot about it. They're not even aware that they qualify. So we're still running into opportunities, and that's why we're doing this, because we want everybody to know that this is still a possibility. So what changed all of this was the legislation in December of 2020. It was the Omnibus Bill, the Appropriations Act, that they throw a bunch of extra stuff in there to clarify some COVID laws, specifically related to the CARES Act, so that they didn't have to do more than one thing. They just put it all through one piece of legislation. 2020, the ERC availability was somewhat limited, but the end of 2020 legislation expanded the availability, the eligibility of 2020 for ERC. It did not change the calculations. It only made it more available. One, it removed the PPP rule. So if you had a PPP loan, you could still go for ERC. And then it also extended it into 2021 calculations changed a little bit, but all for the better. And it extended it, expanded it. But it's important to note those changes are only eligible for 2021. So what we've been doing is focusing on 2020 calculations and 2020 eligibility for all of our clients where applicable. And so we focus all on 2020. We got everybody their filings in for 2020 so that they get the refunds, and then moved on to 2021. So there's still some that we're working on 2020 calcs for because we only recently realized that they were eligible. Clients only really recently realized that they were eligible. Now we're working a lot more now on 2020 calculations and getting those out the door. So how does a business claim the credit? First question is, obviously, are you eligible? For 2020, and we're going to focus on 2020 first before we move on to 2021. Your business had to have been fully or partially suspended. Your business operations had to be fully or partially suspended during at least one quarter in 2020, or you had to have a 50% or greater decrease in gross receipts in a 2020 calendar quarter when compared to the same quarter in 2019. Those are the big two ways that we're seeing people qualify, the companies qualify. There are a couple others in there, but these are the two main. And we'll talk a little bit more later on about what partially suspended means and how many quarters you can qualify for at one time. And here we are with our first polling question. We're only 6 minutes in. So everybody, CPE, true or false? You must have been shut down by a government mandate in order to claim the credit. True or false? Go ahead and pick one. If you stop paying attention for a second, we have our first polling question. True or false? You must have been shut down by a government mandate in order to claim the credit. We're only going to keep this up for about 30 seconds or so. So we're going to give everybody an opportunity to answer that. And in a second, there we go. It's gone. So, thank you. People have been paying attention. So, false, that is the correct answer. You don't have to have been shut down by a government mandate. There's the gross receipts exception or gross receipts qualification. So we'll be digging a lot more into this. So if you got that wrong, don't worry. We'll be hammering home all of these items as we go along. So how does a business claim the credit? Question number 2, do you have qualified wages? If you could answer the first question in a manner that got you eligible, then you have to look at your wages. If you have 100 or fewer employees, all wages are eligible during the quarter in which you experience the gross receipts drop or for the time period that you were shut down. All wages are eligible if you have 100 or fewer employees. And this employee number is based on average employees during 2019. If you had more than 100 employees, then you had to have the only wages that qualify are wages paid to employees not to work. Obviously, a very big difference there. There aren't a ton of situations where employees were paid not to work. So that's something obviously you got to keep in mind. Talking a little bit more about the government shutdown. So like we said, you have the government shutdown by government mandate, and that's important. It has to be a governmental mandate. State and local jurisdictions, federal, it has to have been a government mandate that you had to at least partially suspend your operations. And there's a caveat in there that says you could not, if you were able to operate remotely in a similar capacity, then you weren't actually shut down. And that kind of makes sense, honestly. McConley and Asbury, we were in that boat. March 19th of 2020, we got the word, everybody's being shut down. And so originally we were not on the life-sustaining business list. So we just said, everybody grab your computer, grab your docking station, grab a couple monitors, go home, plug in. Some people that worked perfectly fine for. They were back up and running that afternoon. Some people, due to childcare, a whole other host of issues, weren't able to quite operate to this at the same capacity. But by and large, as a firm, we, fortunately for us, we had all the technology in place ahead of time that we were able to just flip the switch and operate it remotely. So we were never, by the definition for ERC, we were never shut down. Now, within, I think, 48 hours, we got added to the life-sustaining business list. So it wouldn't have affected us anyway. But that's a perfect example. So if you're able to operate remotely, then you're not considered to have been shut down. So then the next question is, as we saw in there, what does fully suspended versus partially suspended mean? The single biggest example of this, and best example of this, in my opinion, that we can probably all relate to is the in-person versus takeout dining. So in-person dining, going in, sitting down in the dining room of a restaurant was shut down for, I don't even know who knows how long, and it was on again, off again. But takeout dining was allowed. That is the clear example there of a partial shutdown. So, and in that example, I can think of the Chick-fil-A. I live in Lancaster, so I'm thinking of the Chick-fil-A in Lancaster. I don't know what their numbers are. My guess is they actually did better from a gross receipts standpoint, possibly even a bottom line standpoint, by having just drive-throughs. Obviously don't know that to be the case, but that, if I had to guess, that would be my guess. So they were clearly shut down, at least partially shut down, because they couldn't have in-person dining. But they probably didn't have a gross receipts job. Definitely not a 50% gross receipts job, but they still qualify. The next good example of a partial shutdown is, were your hours reduced? We had a client who is a car repair shop, tire shop. They, for whatever reason, they were deemed to be life-sustaining because people needed to, have a car to get to work and get places. So they were able to operate, but they said you had to limit your hours. That's clearly a partial shutdown, because obviously you can generally make more money if you can be open 12 hours versus only 6 hours during the day. If you have different aspects of your business that was deemed life-sustaining, and another aspect of your business that was deemed to be not life-sustaining, so you're only able to continue operating a portion of your operations. That would clearly qualify. If they said you're only allowed to have essential operations, I think operations. Well, I'm thinking of a business term, but in the medical world, they shut down elective surgeries. So clearly that would be a partial shutdown. On the construction side, I know that construction companies, many were able to finish existing projects. So if you had half of a house done and you needed to at least be able to finish up that house so it wouldn't be exposed to the weather and everything else, that would be a partial shutdown. So you're able to continue operating, but only on those half-finished projects. You were only able to finish those, and then you had to shut down your operations. So that would clearly qualify. When we look at the drop in gross receipts, if you qualify under the 50% drop in gross receipts, it means that you will have at least 2 quarters of eligibility for 2020. The reason for this is your eligibility period begins in the quarter where you had the greater than 50% decrease in gross receipts. Your eligibility period only ends at the beginning of the first quarter after the quarter in which your gross receipts go back up to at least 80% when compared to the same calendar quarter in 2019. So we're going to talk about this a little bit more later on, but you should know if you can qualify under the gross receipts drop in 2020, you will get at least 2 quarters. On the shutdown, you're not eligible for the entire quarter, only during the period where you were shut down. So I think of businesses in Pennsylvania that were shut down on March 19th, and then their county, whatever county they were in, went green on June 1 or whatever. So you would then be eligible for wages paid during that shutdown period from March 19th until June 1, not the entire quarter. So keep that in mind too. All right, oh, there's my polling question, a little behind there. So how does a business claim the credit? What about wages paid with the PPP loan? Payroll costs, this is where they don't get you with the PPP loan. All they're saying is you're not allowed to double dip. So old rule was if you had a PPP loan, you were not eligible for the employee retention credit. New rule is that yes, you can get the employee retention credit, be eligible for it, even if you had a PPP loan, but you can not double dip. So the wages that you paid with your PPP funds are not eligible for ERC, which makes sense. So the payroll costs, and this is where presentation on the PPP forgiveness application comes into play. So you have to look at your application, and this is where this is where kind of our work gets complicated, because when you have overlap with ERC eligible wages and PPP covered period, you have to look at a bunch of different things. So one, did you have excess payroll costs? Many PPP application for forgiveness, they had, say your PPP loan was $200,000, you're throwing every single dollar of payroll on your application for forgiveness and not worrying about it. So because you didn't care about anything else, you just wanted to make sure you got full PPP forgiveness. So you're throwing $400,000 of wages on there. That's totally fine. That does not hurt you at all when it comes to ERC. Other piece is, did you use the 8-week covered period or the 24-week covered period for your application? We're going to go through an example for that later on that will explain why it was always better to use the 24-week covered period. If you use the 8-week, that could hurt you a little bit depending on timing and overlap of wages. But if you use a 24-week, you should be pretty good. The 60% test we have noted on there. To get full PPP forgiveness, only 60% of the costs that justify the forgiveness had to be payroll. So did you put non-payroll costs on there kind of as a safeguard? So your PPP loan was $200,000 and you put $300,000 of wages on there, and then through another $50,000 of non-payroll costs on there just as a safeguard. That is a win-win, because when we look at your application for forgiveness, compare that to the wages eligible for ERC, that putting those $50,000 of non-payroll costs on there frees up even more payroll costs. Problem is, they said if you did not put the non-payroll costs on there on your application, you can't go back and change it. It's unfortunate because a lot of applications for forgiveness were submitted before the ERC was available, and so people didn't bother with non-payroll costs because that was seen, I think, a little bit as kind of a no-no to put non-payroll costs because obviously PPP was meant to replace payroll. So people were scared that if they used, excuse me, if they used non-payroll costs, that they were going to somehow get dinged for using non-payroll costs. Obviously, we know now it doesn't matter, but we didn't know that then. So unfortunately, if you could have put non-payroll costs on there, even if you didn't need them, a lot of people didn't. So so it hurt a little bit there, but we have that hasn't caused too many problems for us. So so now we're going to look at how much of a credit do we actually get. For 2020, again, we're only talking about 2020. 50% of up to $10,000 in qualified wages per employee. That is the amount of the credit. The wages paid must be paid in the affected quarter or during shutdown period, and the cap is for the entire year. This is a big difference. We'll be talking about this more. This is a huge difference between 2020 and 2021. So 2020, max credit you're getting is $5,000 per employee. You can only take 10 grand of their wages for the entire year. It's not per quarter. For the entire year, you get a credit for 50% of that. So it's just 5,000 bucks. Next piece on how to claim the credit. At this point now, we're just looking at 941Xs. So preparing an amended payroll tax filing, we submit that. We claim a refund on there, and then we wait for the refund to come in the mail. People have asked, how's it going to show up? It's literally just a check. And we have seen in the memo portion or whatever, it'll say 941 and like Q2 2020 or something like that. So that's all it is. There's no fanfare. And we'll talk about, again, we'll talk about this later on too, but it's taking forever. We've seen them speed up a little bit, but it is taking forever for the IRS to issue refunds. So if you're sitting there today thinking, oh, I totally qualify for this, and don't think you're going to be getting your refund anytime soon, it's taking months. So application for forgiveness. If you had a PPP2 loan in 2021 and you haven't submitted your application for forgiveness yet, unless you're up against a deadline, there's just no reason to submit it. But what I will say is maximize your non-payroll costs, use the 24-week covered period, and an example we'll walk through later will show you why. But there's just no rush to submit it. Hold off, make sure you're looking at everything appropriately, make sure you're maximizing your non-payroll costs because that'll free up more payroll costs for ERC. The reason I'm saying this is because if you were operating and paying employees, so a lot of companies had a really hard time in Q2, Q3 of 2020. Q4 we saw a lot of companies kind of getting back to normal. They had figured out how to work, however, to do this. So you're gonna have, so if that was your case, you're going to have excess payroll, and that excess payroll should be eligible for ERC if you're eligible. So one example, so say you had a PPP loan for $500,000 that you received on July 1st of 2020. Your covered period then, assuming you use the 24-week covered period, which again we're recommending, runs from July 1 of 2020 roughly through December 31st of 2020. So then, say you're eligible for the employee retention credit during Q2 and Q3 of 2020. On your application for forgiveness, you showed $500,000 of payroll costs to get full forgiveness. So in your head, you're thinking kind of a FIFO basis of payroll. In your head, you use the first payroll incurred to get full forgiveness, all of which would have been in Q3. So you're thinking now, crap, I just screwed myself because all of the I used all the payroll in Q3 for PPP forgiveness, but all of that payroll in Q3 is now eligible for ERC. Since the covered period also includes Q4, and as long as you check the box to use the 24-week covered period on there, you probably had enough payroll in Q4 to cover all of your PPP loan. So what we'll do is, and the IRS, they don't care. SBA, IRS, they don't care where that payroll fell, whether it's in Q3 or Q4, as long as it's within your covered period. So most likely you had enough payroll in Q4 to cover all of your PPP loan. And so we'll look at that and we'll say, yes, we have enough payroll in Q4 to cover the PPP. So now all of our payroll in Q2, that was not an issue from the start because you only got the PPP loan in Q3. And now all of your payroll in Q3 is eligible for ERC. So we should be able to maximize that. Second example, assume the same facts, except you're eligible for ERC in Q3 and Q4. So now your PPP covered period and your ERC period are the exact same time period. And now you're thinking, oh, I'm definitely screwed. There's no way I'm going to have enough payroll to cover both PPP forgiveness and get full ERC. That's not necessarily the case. Because, like we said, you can only use $10,000 of payroll per employee for the entire year. Many employees, I don't know about most, but many employees, their payroll for 6 months out of the year is going to be more than $10,000. So if you had, let's say, your average employee, made, $15,000 or $20,000 per quarter, you can take that extra 5, that extra 10 above the 10,000 ERC threshold, apply that to your PPP forgiveness. And as long as we have enough excess there, we can get full forgiveness on PPP and get full benefit of the ERC. So this is where kind of that in-depth analysis comes in. And when we start looking at payroll reports, we look at payroll reports by week, depending on coverage. That's the other thing. In these examples here, I'm using just, nice and cut and dry, pretty Q3, Q4, first day of the month cutoffs. That doesn't happen in real life. So it's a lot of weekly payroll runs. It's a lot of pushing payroll into this time period and this time period and making sure we know exactly when it was incurred, and so that you can maximize both. So when you do have concurrent periods like this, it gets a little more complicated, but we've seen a ton of benefit there. All right, moving on to 2021. We've covered 2020. And again, if you have any questions, particularly about 2020, send them through the question chat now, because we can address that while we're still on 2020 if you haven't. All right. Changes to 2021. Like we said before, we had 2020 rules, and then the appropriations bill changed the rules for 2021, largely for the better. First, most obvious one is in 2021, you're going to get 70% of all of your qualified wages. And here's where it gets even better. In 2021, you get $10,000 per employee per quarter. So in 2020, we were just getting $10,000 of wages times the 50%. So we're getting a $5,000 credit per employee, period. We're done for all of 2020. For 2021, we're going to get potentially $10,000 of qualified wages per employee times 70%. But you can get that for all 3 quarters. So you can get $7,000 potentially per employee per quarter in 2021. Now, it only runs through Q3 of 2021, so you can only get 3 quarters worth, but still pretty darn good. If you add all this up, and you might have heard commercials, I don't know what I'm listening to where I hear all these commercials, but I'm hearing a lot of commercials for random organizations just, saying you qualify for ERC. If you're not looking at this, you're missing out. And there definitely plenty are. But the number they're throwing out there is $26,000 per employee, which sounds like a lot, and it is. But you can potentially get $5,000 in 2020 and then $21,000 in 2021 per employee for a total of $26,000. I haven't seen, I'm not aware of any clients who were eligible for everything in 2020 and all 3 quarters in 2021. I feel like if you were eligible for everything, it's either like, a perfect storm scenario or your business is really hurting. But nonetheless, it's there, and I'm sure there are examples out there where it's happening. The gross receipts test for 2021, like we said, for 2020, you had to have a more than 50% drop in gross receipts compared to the same calendar quarter in 2019, and it only ended when gross receipts exceeded 80% of the receipts from the same 2019 quarter. For 2021, that 50% increases to 80%, meaning you had to be less than 80%. So if you have a more than 20% drop in 2021, you qualify. And to make it even more exciting, you have the option to use a prior calendar quarter versus that same quarter in 2019 to qualify for the same quarter in to qualify for the next quarter in 2021. So 1 quarter in 2021 can get you 2 quarters of eligibility. And in 2021, it's a quarter by quarter test. So you have to look at each quarter individually, whereas in 2020, you could double up on the quarters with 1 quarter dropping 50%. But for 2021, many will have the potential for 2 quarters. So if you had a Q1 drop in 2021 of 25%, that'll make you eligible for both Q1 and Q2 of 2021. If you have a Q2 drop of 25%, that'll make you eligible in Q2 and Q3 of 2021. So the only time that you only have 1 quarter qualify is if your only quarter is Q4 of 2020. It's another thing to point out. You can use Q4 of 2020, or if Q3 of 2021 is your only quarter that qualifies. So like we said, but this does present a pretty good opportunity. So if you, some people are forgetting, well, I never had a greater than 50% drop in 2020, so I don't qualify, right? Correct, you do not qualify for 2020. But if you had a 25% drop in Q4 of 2020, that will qualify you for Q1 of 2021. And if you walk through all of these scenarios and match everything up, you could only have 1 50% drop of any quarter, but you can qualify all the way through Q1 of 2021. So say you had a 51% drop in Q2 of 2020, and then you had a 25% drop in Q3 of 2020, you're still not back above that 80% threshold that starts cutting you off. And then you had a 20, I guess that would have to be a 20.1% drop in Q4 of 2020. That will then, so now you're qualified for all 3 quarters in 2020, and that 21% drop in Q4 of 2020 qualifies you for Q1 of 2021. And then you start measuring for 2021. So you could have a 21% drop in Q1 of 2021. That will qualify you for Q2 of 2021. And then say you had another 25% drop in Q2 of 2021, that'll qualify you for Q3. So you can get there faster than you think if you just read the rules and understand how all this stuff is working. All right. Shutdown test. There's no change to this. Any quarter where there was at least a partial shutdown qualifies. Now again, that will not qualify you for the whole quarter necessarily. It'll just qualify you for the period of time that you were shut down. Employee threshold. So for 2020, like we said, you only needed 100 or fewer employees. And if you were under 100 employees, all wages paid qualify. If you had more than 100 employees, only wages paid to employees not to work. And it's ironic because we did have a couple examples where companies were shut down. They had more than 100 employees, so the only wages that would qualify were to employees not to work. And so, we started asking those questions. Well, did you pay wages to employees not to work? And they said, well, like, what do you mean not to work? We had people, the shop was shut down, but we kept paying people and they wanted to do something. So they would come in and maybe one at a time and clean up. And maybe they were doing that on their own. And it's like, well, if they were coming in to work, even if they're not doing the job that they were hired to do, they're still working because, everybody wants to do something to help out. Nobody wants to pay somebody to do nothing. When ironically, you would have been better off now in hindsight with the ERC to pay them to do nothing. Some people were sent home because they couldn't work in the shop, and they would drop off, administrative stuff for them to do that they could do at home, stuff that had gotten, piled up and needed to be done. And so they said, hey, you're sitting at home, not doing anything, we're still paying you, so can you take care of this admin stuff? Oh yeah, sure. So they're doing it at home. Again, ironically, you would have been better off in hindsight with ERC to have paid them to just simply not work. In 2021, this is a big change. That threshold goes up from 100 to 500 employees. So even if you have 499 employees, all your wages qualify. You didn't have to pay people not to work. Get above 500, now you had to pay people not to work. We did have a large retailer who, again, didn't think they would qualify, didn't have gross receipts drop, but then they started asking questions. We started asking them questions to say, hey, did you have, were your stores shut down? And they're like, oh yeah, we were having random stores shut down all the time for COVID stuff or whatever, even if it was just for 24 hours, whether it was, there was an exposure in the store and the state said, okay, you have to shut down for 24 hours in order to deep clean your store. That's a government shutdown for 24 hours. And they still paid their employees, even though they couldn't come to work. And these were employees just working in the store. So they're at home, sitting there doing nothing. And I said, oh, well, how much did you have? It's like $15 million over 2 years for two employees not to work because they had these random stores being shut down all the time that they hadn't have the deep cleaning. So and that's a very clear qualification. So there are examples out there. We just need to make sure we're thinking a little more about them. All right, now we have our next polling question. True or false? I threw a curveball in there. So CPE polling question, true, false, or it depends. If I have 200 employees, all wages potentially qualify. True, false, it depends. If I have 200 employees, all wages potentially qualify for ERC. Drop your answers in there. True, false, or it depends. And I'm running out of seltzer water here, so you're gonna have to excuse me if I cough a little bit. All right. Oh, well done. Looks like many of you were listening. So correct answer is it depends. So if you have 200 employees and you're in 2020, then all your wages will not potentially qualify because you'd have to be paying employees not to work. If you're in 2021 and you have 200 employees, congratulations, all of your wages potentially qualify. All right, so here's where we're starting to really get into some nitty gritty on companies qualifying. So IRS Notice 21-20 addresses a whole bunch of examples and issues on how companies can qualify. And one of the questions in there, which was a little bit of a surprise to us, was if I have a supplier who is shut down, I can't get the raw materials to run my business, does that qualify as a shutdown? The answer is, like everything in tax, it depends. So in the notice, in the IRS notice, it's very clear you had to have a supplier shutdown. And this supplier must have been supplying a critical item to your business. So it must be critical. How do you find critical item? Case by case basis. You must be unable to find a replacement. That's the second piece of it. And third, your supplier must have been shut down due to a government mandate. So just a supply chain issue, even if it's related to COVID, may not necessarily qualify you because you have to tie your supplier shutdown to a government mandate. And you must have been able to unable to find a replacement. Back to the critical piece. So, you know, I'm trying to think of an extremely obvious example. Say you're a home builder and you're unable to get lumber. You're unable to get 2x4s, 2x6s, decking, everything else, because your main supplier was shut down because they had, you know, I don't know, they had an outbreak at the location. So the state said, you have to shut down for a week, 2 weeks, whatever, and deep clean your facilities, get everybody home healthy before they can come back to work. So you're now 2 weeks behind on getting lumber. So now you can't build homes. So you're essentially shut down. So what do? You go out and try to find a replacement. Well, as we all know, 2020, 2021 for lumber the price went through the roof and it was very hard to find. So it is entirely plausible that you would be unable to find a replacement for those 2 weeks to get you lumber. And like we said, we already tied the supplier back to government mandate. Clearly, lumber is critical to a home builder. That would be a good case for qualification. Now, qualification would only be for those 2 weeks while you were shut down. And if you're in 2021 and you had less than 500 employees, any wages paid during those 2 weeks would qualify. But again, you had to be paying the wages. If you didn't pay the wages because maybe you're using, I don't know, maybe you're using contractors. Maybe you don't even have employees. They would have to be wages paid to employees. But if you do have employees and you said, hey, I'm really sorry, we're gonna have to furlough you for 2 weeks because we can't build any homes, then you don't have any wages that would qualify. But you could potentially have 2 weeks worth of wages to qualify, even though you were partially shut down, and if you paid them, even though you couldn't operate at full capacity. The second piece to this is we're seeing this supply chain issue being tied in with the partial shutdown, and that's kind of the example we just walked through, being tied in with this partial shutdown idea. And we're seeing a lot of ERC service providers being extremely aggressive in this area. So then we start getting, and what they're doing here is they're really digging into this definition of partial shutdown. In IRS Notice 21-20, they define, they say that the partial shutdown must be more than nominal. So if it's more than a nominal portion of your business that's shut down, it's going to qualify. So then the obvious question is, well, what the heck is nominal? They define nominal as more than 10%. So, and that's based on gross receipts and or hours. So if 10% of your workforce is all employed in one area that gets shut down, presumably you're going to meet the hours requirement. If 10% of your sales are some raw material that you can't get, or you have a plant that represents 10% of your business, and that plant itself is shut down, you now have a partial shut. Here's where they're starting to push the issue. One example I've heard is, or one position I've heard being taken is, well, they're saying that you have to have more than a nominal shutdown, and that's kind of where the explanation ends. And they're defining more than nominal as, or they're defining nominal as 10%. So what they're saying is the only way to qualify is, or one way to qualify would be is if you have a more than nominal shutdown of a more than nominal portion of your business. If you do the math here, that's 10.1% times 10.1% of your business, which means you're now down to 1.2% of your business. So they're saying 1.2% of your business is shut down, and that makes you eligible for the employee retention credit. I have a really hard time supporting that position. In my opinion, if the IRS wanted that to be the case, they would tell you that's the case. I can see how they get there in their math. My concern is there are some companies out there that have recognized that ERC is a huge opportunity. So they start providing the services, and they're getting a lot of money back for clients. And then at some point here, ERC is going to dry up by definition, because it ended as of the end of Q3 of 2021. They get paid when you pay them. When you get your refund, then you pay them out of your refund. And we're seeing fee ranges in the 15 to 20% as a contingent fee on your refund. And they won't sign your 941X because they're saying they're not a tax preparer. I have trouble with that because, in my opinion, they're a tax preparer. If they're not willing to sign the 941X, well, the rules say if they are a tax preparer, they can't just charge a flat contingent fee. So what they're saying is they're a consultant, and because they're not a tax preparer, they can't sign your 941X. This is where I think we've gone awry a little bit, and goes well beyond the spirit of the employee retention credit. But nonetheless, there are some plenty of firms out there doing this. And who knows? Maybe the IRS will audit this. That's the other thing. The IRS isn't going to get to these for a while. I mean, they're 2 years behind on auditing anything, let alone employee retention credits. So then may say they do audit these, and they say, no, this 10% of 10% doesn't fly. And they start assessing, they start assessing tax to recoup the refunds that were paid. Well, you've already paid the person who did the study for you, and whoever did the study for you, are they still around, or were they just set up to do ERC, and then once ERC dried up, they went away? So this is what we're seeing right now, but doesn't change anything from everything else we talked about. There's still potential there. If you qualify, you know, we need to look at it and make sure you know what's going on. All right. Shutdown of customer. So this was another example that the IRS has in there in IRS Notice 21-20. Just to make it clear, if a customer was shut down, does this qualify you for employee retention credit? Technically, it does qualify, but the only way that you can measure it is if you had a gross receipts drop of, you guessed it, more than 50% in 2020 and more than 20% in 2021. So just having a customer shut down doesn't qualify you. It's the gross receipts drop that qualifies you. There's a question, I've been hearing questions, what about a voluntary shutdown? You know, in March, April of 2020, things were getting bad. We didn't feel comfortable having people in the office, so we sent them home. We continued to pay them for whatever work they could do. We were just being nice people. Unfortunately, being a nice person in this situation does not qualify you on its own for employee retention credit. You have to have the government mandated shutdown, or you have to have the gross receipts drop. All right, our final polling question. Final polling question for those of you looking for CPE. Here's your third and final polling question. True or false? I may be eligible even if I was not shut down by a government mandate nor had a decrease in gross receipts. True or false? I may be eligible even if I was not shut down by a governmental mandate nor had a decrease in gross receipts. True or false? And it looks like we don't have any questions as of yet. If you do have questions, please submit them through the chat. We're gonna have a couple extra minutes minutes here to go over any questions. Don't worry, we're over the 50, excuse me, over the 50-minute mark, so you still get CPE. True, yes, 72% of you said true. The example we walked through on the supply chain, if you have a supplier that was shut down, providing you with critical goods that are critical to your business, you were unable to find a replacement, and the supplier, not you, but the supplier was shut down due to government mandate, there's still that potential there. All right, other considerations. How we claim the credit is you file the 941X and then you just wait for your refund. Like I said, it's taking months, not weeks, but months. The other piece of this is your expenses must be reduced by the amount of the ERC. So as we all know, PPP loans, forgiven PPP loans did not have a tax impact. You didn't pay tax on it. That is not the case with the employee retention credit. You must reduce your payroll tax expenses, and it essentially turns it into taxable income. The catch here is they're saying, the IRS is saying the return for the year where the wages were originally paid must be the return that has the reduction in expenses. So if we go back and amend a 941X now for 2020 to take employee retention credit, the IRS is saying you must amend your 2020 tax return, which means if you're a flow-through entity, the owners must also amend their tax returns. Our business is doing this. I'm sure plenty are. I'm sure there are also plenty who are saying, good grief, I'm not gonna do that. I don't even know if I'm gonna get my refund. So you're asking me to pay tax now when I don't even have the refund yet? I'm just picking this up in the year I get the refund. Make the IRS come back to me and say you were supposed to pick this up in an earlier year, even though the tax answer is exactly the same. Is the IRS going to really do that? I don't know. If you ask me, I have to tell you the correct answer is amend the year in which the wages were paid. Practical application, we're seeing some clients not do that. So we do have a couple questions in here now. It says, I have been aggressively pitched for ERC credits with incredible claims, like almost 80% of their clients qualify. I have a hard time believing them. What is your estimate on how many firms should qualify? Gross receipts grew by more than 20%. This is where we're seeing that supply chain thing, and that 10% of 10%. That's where we're seeing them go after this. In all fairness, right now I have a client who was pitched by a firm, and they're saying that every single dollar of payroll paid for the first 3 quarters of 2021 qualifies. And both the CFO and I are in full agreement that that doesn't make any sense. They still have not provided the detail of the support that they're going to put on the 941X to justify this. I have a really hard time believing it. So what percentage of businesses qualify? That's hard for me to say, because I'm only focused, because almost 100% of the businesses we've looked at qualify. But the only businesses we've really looked at are the ones we kind of thought would qualify. And so it's skewed a little bit. But if we start looking at businesses with under 100 employees in Pennsylvania, there's a really good chance that you qualify, because everyone in Pennsylvania was shut down effective March 19th, unless you were a life-sustaining business. And many companies had a gross receipts drop for at least 1 quarter. So I would think a very large percentage of smaller businesses in Pennsylvania would qualify for at least a portion of 2020. 2021, not nearly as many, but 2020, I think there's a lot there. Next question. Are vacation time and vacation pay qualified wages, or overtime and vacation? Yes. If you're for 2020, if you're under 100 employees, any wages paid qualify. Overtime, vacation, everything qualifies. If you're more than 100 employees in 2020, vacation time and overtime would not qualify, because vacation time is pay that they've earned otherwise. So while you're paying them not to work, they've essentially worked to earn that vacation pay, so it does not qualify. Overtime, obviously, by definition, would not qualify because they worked to do that. Same thing with 2021, just change that 100 employee number to 500 employees. So one final note, looks like that's it for our questions. One final note, one thing we did not talk about is recovery startup businesses. In this case, if you started a business after, I believe it's March 15th of 2020, or maybe it was February 15th of 2020, if you started a new business, then you potentially have wages that will qualify for the employee retention credit. So if that's the case, and you did start up during the pandemic, there's definitely a possibility there. What we don't know is, and the IRS hasn't really provided any guidance, is what if you have one business and you start a new business, and the one business was a home painting company and the other business is a, I don't know, a home washing company. Is that actually a new business? I don't know. So that's one thing we're dealing with, but everybody should know the recovery startup business exists. There's potential out there if you started a business during the pandemic. That is all we have for today. Thank you for joining us for today's webinar. If you have any further questions, please feel free to reach out and we'll be happy to assist. A recording of today's presentation will be posted on our website and social media sites in a few days. And for those of you who requested CPE and answered the polling questions, those certificates will be sent out in the next 2 weeks. Thank you again for joining us, and I hope you all enjoy the rest of your day.